Perfect. There we go.
Awesome. Awesome. And let me pull up one thing on here. Let's see.
Try to move over and get the lighting a little bit better here.
All right. So let me give a quick introduction of you, David, to the audience here, and then you can go ahead and take it away. And I'll have everybody hold your questions to the end. But if you have questions throughout, feel free to go to that Q&A box and type them into the Q&A box. And that's how we keep track of the questions, so we can make sure we answer them as many of them as possible. So as David is going through the information, feel free to go to that Q&A box and type in a question. And then, David, at the end, I'll make sure I tee those up for you after you're done with your presentation, okay?
Okay, sounds good, Dan. Thanks.
Awesome. So let's talk about David a little bit. David Thompson, he is with a company. He has a company called Thompson Investing. He has experience in real estate investing in both domestic and international projects, covering single-family, multifamily, and land development. After a 20-year career in the corporate world, he started Thompson Investing and has raised significant private equity capital, providing investor funds to purchase over 4,500 apartment units worth over $300 million. David, thank you so much for being with us here this morning. I'll let you go ahead and take it away.
Sure, Dan. Thanks so much. I really appreciate the introduction. I appreciate you being here. Hopefully I add some value to your guest today. And I've been doing the capital raising now for a little over 3.5 years. I didn't know that's what I was going to be doing when I first got into the business, but it's been a good run. And I'm thinking back to my first time when I raised capital, when I was thinking about this presentation, I was like, well, okay, things have changed quite a bit after 25 something deals. You kind of mature and you learn things, and you morph into some different ways of doing the business. It just evolves. But anyway, I put my hat on because I do mentor folks that are interested in this area, but I also talk to a lot of new operators who are interested in getting us to fund their deals. So I do share some thoughts and advice with them. So hopefully it's relevant, and hopefully the things that we talk about today someone can take away and utilize for their first deal, or we can also talk about, as you get going, how this thing matures and how you can get a little bit more focused on some different strategies. So let's do this. You gave me a little introduction, so I don't really have to do too much there. I really focus on education with investors in 3 different niches. I'm going to probably talk more about apartments today because I think that's what a lot of folks start with. I don't have to talk about the benefits to most of your audience. A little bit about me, Dan. So you already talked about the corporate role. I reside in Austin, Texas. Been there about 20 years. I'm actually in California today. It's a little early for me. It's about 6:30 in the morning. I think when we set up this schedule, I wasn't sure where I was going to be, but actually I'm talking to investors and having some fun with my family on the West Coast. So I think what's important is that my business, as it's morphed, it's now more interfacing with investors face-to-face, wherever I can be, and more efficiently. I do presentations a lot more than one-on-ones, but so we can talk about those kind of strategies. I do active and passive investing. I do have single-family and multifamily. I learned how to do that business. It didn't scale real well, so I got into syndication, and then I founded my company, as you mentioned. Won't go too much into this. This is kind of where we stand today. So I guess I can tell people it happens pretty fast. I mean, I really didn't get into syndication until 2016. Raised $1 million in my first deal in 2 weeks, working with Joe Fairless. A lot of people know Joe. I think he's the host of this particular summit. And I've been working with Joe, I guess now on 17 deals. Outside of Joe, I probably raised more capital than anybody for his deals. But I also moved into self-storage and mobile home communities and raised capital for other apartment vendors. So I moved out. We've got now in 2019 a total of 26 syndication deals. As you mentioned, a lot of apartments, 6,000 apartment units were invested in, and thousands of self-storage mobile home communities. And so a lot of capital raised in a short period of time. And it's really a fun business. I've really enjoyed it. And hopefully we can talk a little bit today with your investors about some things to think about to kind of go in a successful direction. So here's what I put together. It's not a long involved deck here because I think we can talk about each one in a little bit more detail. But this would be my top 5 tips, for kind of your first deal. And then I have, 5 essential tips for successful capital raising. so we'll start with, hey, what do you need to do on the first deal? And we'll go from there. I think the number one thing I see people make mistakes is, you meet somebody at a multifamily meetup group or, in some kind of venue where people are talking about apartment investing. And, they may meet someone at that meeting. They may bring a friend, they may bring a family member, and all of a sudden those are their partners, and not saying that couldn't be successful, but I think if you look back on it, you probably would appreciate that most of the folks that really get going in this business and do well at it, they typically aren't family members or friends that they started out with. They're really trying to find people who complement their skill set. So, when I started, knowing what my skill set was, I was trying to learn about apartments and working with Joe. He was mentoring me, and I was thinking about getting some friends together and go buy apartments. And so I would have been making the first mistake, right? I just get some friends together that I know who are interested in investing, and we go look for apartments. And that's not really the best way to do it, because at some point you're going to be talking to investors, and at some point you'll be talking to lenders, and they're all going to look at you like, what have you done? What's your experience? So you really got to, and the operators I deal with today, and looking about how they started, they really surrounded themselves with experts. They certainly weren't the people that found the deal oftentimes. They weren't the people that did the analysis. They weren't the people often that asset managed the property or dealt with a property manager, and sometimes they weren't the person raising the capital. So I recognized early on that it's a team sport. And I'm not saying on your first deal you shouldn't be learning a little bit about everything, but it certainly will benefit you if you really think about your team. And if you're responsible for assembling that team, what's that team look like? Now, the team goes far beyond just your couple of partners or partner in business that you may do several deals with, right? So that would be, if I was starting out and I was looking at my first deal, I would build the best team around me as I could. That may make sense to people and may not, but it seems logical that you would look for, if you're doing value add apartment renovations, you certainly would comb the market in the area of these apartments that you're looking for and try to find some of the best property managers, not just managing the apartments, but typically, we're doing renovations, right? So there are companies out there that will handle all of that for you. And, that's what you want to do. You want to build hopefully that company's been around a while, has shown success, because that's really part of your team. Also, you can have an advisory board. You certainly could, and I think that's wise. Having people have a lot more experience that have taken down deals before, and that can help you definitely with the lender and also investors. Getting people who have shown a nice track record that would lend their name to your deal. Maybe you give them, a much bigger part of the deal. I think that's what you have to do. Give up a lot in the beginning because you're just wanting to get experience, right? And so I think that's really it. Look at your skill set. Are you extroverted? Do you enjoy educating people, talking about why apartments are a great place to be? You can tell a nice logical story, not too complicated, simple. And that would be that might be your role as far as more focusing on the capital raising. And if you are more, I don't want to say introverted, but you're a little bit more focused on numbers and you love spreadsheets and you can spend behind spreadsheets all day long and love to go out there, kick the tires and look at deals and analyze deals. Maybe you're not the person that should be capital raising. You think you have to because you're told you need to raise capital for the deal, but maybe you find people like me who like the other part of the business, and we like to educate and get folks excited about the deals that you might be doing. So we partner together. So that's my number one tip. Look around who you're partnering with. Make sure they're complementary. Make sure they're really adding a lot of value to your resume, because you're going to be basically sharing this bio in the investment summary deck or whatever marketing materials you may be providing your investor base. You really would want to build that strong team on your first deal because you don't have the experience yet, and that's okay. Everybody started where you were, right? So, the key here is get that team built and don't take that tip lightly. I think that's my number one tip, and it's my number one tip for whether it's your first deal or your 30th deal or your 50th deal. It's still my number one tip. When I'm dealing with operators, as a partner with them, I am selecting experts in their niche, in their market. I'm selecting experts, and I don't support and work with too many new people because I don't want to bring my investor base to you yet. You got to prove yourself a little bit, right? So conversely, if you're talking to lenders, they want to make sure if they're going to lend you money, just like an investor is going to give you money, that they can rely on you to execute the business plan that you are sharing with them. So, that's number one. And if you can just take anything away from this discussion, Dan and the team here, I think that would be it. And Dan, I don't know your thoughts. What's your experiences? I don't know what you think, but most of the folks that I talk to would probably say it's definitely right up there, if not the number one thing, the top five for sure. Okay, the second thing I think is, this is interesting to me. I shied away from the business of anything to do with marketing and sales for probably 20 years. I have a financial planning degree, and I came out in age 22, I think, at that time. And the challenge I had was I didn't really do enough research on what a financial planning career might be. I just thought I got a degree and I go work for a company that does financial planning because I love that field. But I didn't do enough research to understand it's an entrepreneurial field, similar to you when you take on an apartment, you want to do something like that. So what I think is important to note is that I came out and for 6 months, I tried to sell whole life and disability insurance for a big life insurance company to get some experience. It was the only one that was going to give me some compensation for doing some work that I could see that had some kind of a training program. And, what ended up happening is I failed at that. It was a really tough experience for me. I remember, trying to tape I was cold calling. I taped my phone to my hand at one time. I ended it so bad, I hired a cold calling company. I didn't like it so much, and that they never gave me very qualified leads. So after 6 months, I decided I'm going to go to graduate school. And I had this mental block for 20 years that sales and marketing was just something I was not good at, even though I felt like I liked talking to people. I bartended my way through school. That's how I paid my way through school and college. And so I knew I liked talking to people. I felt I could get in front of people with a little bit of a passion about something and educate folks. So I felt I could do that, but it was such a horrific experience. And I think why I bring this up, because if you think capital raising is really selling and marketing, I would say that probably if you had no background in it, you probably could do really well. So people think that I'm really good at what I do. And I'm like, well, I told you I failed at it when I started. And I stayed away from that in corporate roles for about 20 years. I was in supply chain finance. I did a bunch of different things. But when I started talking to Joe about how I could help him back in spring of 2016, one of the things we talked about was, hey, can you go raise some money for me? There I was working with, at that time, that company, Joe's company, Ashcroft Capital, they did not have a lot of deals. It was they only had like 2 deals under their belt. So it wasn't kind of this long track record, but, maybe going back to point one, we really relied a lot on his partner, Frank Rossler, who had, about 8 years working for another company doing underwriting and asset management. So, we just were taking people who we really could rely on to get us that credibility and kind of get going. But, I think the most important thing was I realized when I started capital raising with Joe is, and we'll get down to point 4 in a minute, kind of, good market, good deals, good team. And, I'm working with, credible partners. But the most important thing for me was I was just going to be myself. I was already passionate about real estate, like anybody probably joining this seminar. If you're taking the time out of your day to listen to me or any of the speakers here, you're interested, and maybe beyond just investing, you're interested in this as a business. and it's a wonderful business. But you know, really, I found out just not having a big sales and marketing background, I think played to my advantage. And maybe it'll help some of the listeners out there thinking that, you know, I've never done marketing and sales. And I was just talking to an investor. I'm actually in my investor's house. Kind of an interesting story. More an investor here. I'm in Valencia, California this week, and she's been investing with us for a while. And she knew my daughter just got a job with Disney, and we're out here to tell, why don't you stay, daughter stay. And I said, that's a great idea. We really appreciate that. So we're visiting here. But she's like, you know, I think, you know, what do you think? And you natural path.
Looks like we might have had a little bit of a technical difficulty there with maybe some of with an internet connection with Dave Thompson. So we're going to try to get him back. So stay with us here as we try to get him back on here. He will most likely figure out that he has been kicked off and get connected back in here. So and rejoin. So give us just a few minutes here, and we'll get this figured out.
I think that's that particular, especially when I'm talking to new capital raisers, I like what to do for new when you're talking to them is don't just share a deal with them, right? You know, the deal may make a lot of sense to you. You probably have been living it. And a new investor about apartments, and so many people have never invested in an apartment. So I'm creating like a one page, 2 page special report that would be around, you know, why you like investing in apartments. And it could be 5 bullet points, just explaining why apartments make a lot of sense. You know, they cash flow, they have great tax benefits. You get appreciation, you get depreciation, you know, and just create some kind of a 1 or 2 pager. And that to me goes out to this, you know, the spreadsheet that you probably have created when you started, saying all the people that you know that might be, most of these deals are accredited, might be accredited. I would always send out an email explaining to people before any even deal gets out that way, because you have to know they're accredited anyway to send it to them. I would always send people out, if it's news, you know, your background, a little bit of bio, and why you like apartments. And then that would pretty much be it. And if someone was interested in learning more, great. But that really kind of frames it for them. So when they do look at the deal, they kind of know what apartment investing is. If you're dealing with someone more sophisticated, obviously you don't need to do that, who's already invested in those deals. But I find when you're getting started, if you're new, most of the investors you're talking to are new to apartment investing. So you need to spend a little bit of time with them, educating them, and maybe having a document or 2 that are really simple. You know, you can do a video. But whatever you're doing is, getting them logically to the next point. Why would you invest in apartments? Why has it been a good deal? Why is it fairly low risk? What's the return profile been on apartments? What's the risk in apartments? I got a couple slides in this deck I threw in there that you're welcome to borrow. I think they're pretty powerful slides on how apartments held up in 2009 crash. It's the most powerful slide. I've done 25 deals now. I still show that slide, or I'll pro-offer it to people because I really want to get this thing framed up right. And that leads me to frame it. So on the frame it piece, it's, you really want to make sure, so if I can move Dan over to the right a little bit there.
Looks like, Dave, your PowerPoint might have dropped off. If you want to try to press that share button again one more time.
Oh, okay.
There we go.
Is that better? Okay.
Yep.
Thanks. Yeah, it looked like something was happening there on the screen. So we've covered, partnering with experts is key. We covered, being yourself. Don't have to feel like you sell anything. Definitely want to be educating. Maybe developing something that kind of gets your investors thinking more about why apartments in general versus the deal. When it actually comes to the deal, this is a fundamental framing exercise that, I teach fellow capital raisers and also follow myself is, I want to frame this thing as a good market, a good deal, and a good team, right? And keeping things simple and logical with investors is very important to me. And I think it's to them as well. So, if it's a market, we want to make sure we're in a market with a, population and job growth exceeding the national average. We want to make sure that it's a market that's diversified job base. And, you can go through a variety of things. You want to make sure, hey, the submarket within the city that we're looking at, like Dallas, Texas was, for instance, has 28 submarkets. Well, why don't we be in the top 10%, 15% of those kind of submarkets that have the fastest rent growth? Something's happening there. It's a gentrification process happening in that submarket, or is it just a place where it has the best schools everybody wants to live and all these companies are moving to, which is quite common in Dallas. So that would be the market. I want to have a story around the market. I want to have it in my deck. And I want to be able to talk to that story. It all starts with a good market. The next thing in the deal is I want to be able to share with investors, that I'm conservatively, or our team's conservatively underwriting the deal. And you don't have to go through 20 factors. I think if you could just point out 2 or 3 things. Hey, why do we think we can get rents up $150 over the next 2 years with our renovation process? Okay. Or, adding amenities. What do we think? Well, because we've shown the comps and, apartments within a couple miles that have the same age and number of units who have done exactly what we've done are getting $200 more. That's very simple. It's a simple to get to. It's a simple for investors to understand. That makes a lot of sense. Well, what are we projecting in rent growth? The submarket from third-party analysis says about 5%, which is pretty strong. We're in that submarket for a reason, but we're only going to project out maybe 4% year 1, 3% going forward year 2 on. So take them through some logical 2 or 3 bullet points. You go and say 25 different things, even though the deal might have some more great things. But just take them through a few deal points and assumptions of why you think your deal is conservative, right? And the business plan. I think the business plan needs to be simple. Most of the value add projects I see are pretty simple, but there's no need to complicate it. There's 2 or 3 things that we're doing. Typically it's the interior renovations. Maybe we're fixing some deferred maintenance, but the biggest thing should be usually it's renovation of the interiors, keeping the exteriors nice. we may add some covered parking. We may add first story, walkout fences and yards and things like that, 2 or 3 things. And that's always very helpful. We talk about the team. I think the team's always good. You always want to put the bio of the team. We talked about the experts. Make sure you're putting that in the deck. I deal with quite a few operators. Some of these decks get pretty lengthy. Sometimes it's pretty repetitive. I don't think it has to be a really long deck. I think if you can get your decks to be very logical around the market, deal, and team, your forecasted projections are conservative, and you're just being yourself and taking people through a logical explanation of it. Great. I think that's really it's going to be helpful. I could have put a multiple things in number 5. Some of it may seem pretty obvious, but for first-time capital raisers, I think this can kind of get you. It's a pretty short time window to raise capital, and if you're trying to do it by yourself or with a partner that you haven't figured out the roles and responsibilities yet, and everybody's kind of capital raising, and everybody's kind of working with the lenders, and everybody's kind of going through the due diligence on the property, it can get pretty hectic. You typically have a 4 to 6 week window to get a deal out there, talk to investors, get them to do the soft commits, get them to complete the PPM, get them to have the funds in the bank account, and then close on the property. So 4, 6, 8 week process goes fast. And so I've got folks I work with, and I always encourage them, get out fast with the deal, and take the pressure off yourself. If you go out later with the deal, and people are on vacation, or it's summertime, especially now, it's hard to get people's attention. So you really need to hustle, and I think it gets back to being prepared. Kind of know where this deal's falling in the life cycle of the year. It's the seasonal issues that you might have to deal with. Where is it falling? Are you dealing with an investor base? Like I deal with a lot of deals. I can do 2 or 3 deals at the same time, and when I'm doing that, I'm always cognizant of the fact that, these people are seeing a lot of things, and maybe the timing's not right for someone because they just did something else. But for your first deal, you're not really worried about that. You're worried about creating a spreadsheet of everybody that you know in your universe that might be accredited. That's really how I started. I think I had 130 or 40 folks. I live in Austin, Texas, 20 years. I was in high tech. So, of course, there was a lot of folks I used to work with. But I was just kind of out there, talking to as many people as I can. But I created a 1-pager on why I like apartments. I mentioned that earlier. And I sent that out to people. So in preparation of a deal coming out, they had some idea of what I was doing. And hey, I was working in high tech last 2 months ago or 3 months ago or 4 months ago. Now I'm a syndicator on a syndication team. So I think that really helps. And then obviously once we qualified them, we found that, hey, they might be interested in this, then we can start sharing some ideas around an opportunity. So, but I had to hustle. I really made sure my family knew that, this is a new business for me. And it was, morning to night and a lot of hustle to meet the window. I raised $1 million on my first deal and did it in about 2 weeks. My first investor I met wanted to do $500,000. And I thought this is going to be the easiest business of all time. I remember calling Joe. I'm like, this is really easy. This is always this easy. About a week later, he decided he had talked to his brother or his cousin or someone else was in the apartment investing business, and not a very good area of town, outside another state, but and had a really terrible experience. And that was enough for him to say, I don't want to do the deal. So, I was telling Joe, I was back to square one, and that was after about 3 or 4 days. I really had to hustle. And I really got around and finally found 13 people. There was 140 that were interested enough to move forward. And so really, having been prepared, I had a list of 140 names. I had to hustle. It didn't come as easy, but at the end of the day, I learned a lot about that experience, and kind of went from there. So those are top tips for your first deal. I think I probably could have added at this point, and the more I think about it, is where do you find your investors on your first deal? And I think I had up here the shotgun approach. And let me just flip the next slide. Maybe I took it out of there, but this will be what we're going to get to this in a second. But, you know, when I started out, I was everywhere. I was on Bigger Pockets. A lot of people are familiar with that. I was in the apartment forums, and I was trying to answer as many questions as I could. I didn't have a lot of answers when I first started on my first deal, but I had a lot more than a lot of people because I had been educated by a mentor. I was educated by Joe, and I had learned a lot about underwriting, what was a good deal, what was a good market, what was a good team. I had enough to share. My wife had a pretty good network. Ironically, the things, the multifamily meetup group I was going to, I got a handful of people. It wasn't the greatest place for me from a capital raising because a lot of those folks are active. But I would recommend a shotgun approach when you first start. Any place that you think investors could be, I would be. That's why I'd hustle. I put hustle as the last one. I was going to, you know, work colleagues. I was going to family. I was going to friends. I was going to anybody that on my daughters, both of them were in sports. You know, they're people I met through their swim teams. I was just out there in a big way. And when I was done, those 13 investors, you know, I essentially did a little bit of analysis on that when I got done. And most of them came from Bigger Pockets, and most of them came from my wife's network. And so, you know, that led me to kind of formulate and, you know, further refine the strategy. So let's just see. I'm looking at Dan on a time check. I'm not sure, you know, kind of where we are. I was going to go through this next one real quick, which is really my 5 essentials for long-term success. But do you have a comment at this point?
No, you're doing great. So the time on this one goes till 10:45. So we usually like to try to leave about 15 to 20 minutes or so at the end for questions and answers. So you're good on time.
Okay, just looking. So I'm on.
Oh yeah, so you have about 45 minutes.
Pacific time. So I'm in 10 your time right now, and we're going to go to 10:45. So I got maybe 20 minutes to share this kind of slide with you, I guess, and then we'll do Q&A. Does that sound about right?
Sounds great.
Okay. So this is probably more interesting to me, this part of it, because, you know, this is where I am, right? So been doing this for a little over 3 years now, and in the last year we did 13 deals. So very prolific as far as raising capital and what we're doing. So I sent this. This article came out. This little slide here. I did a blog and you know, it was kind of my 5 essentials to raising capital, and that was after about 13 deals. So I don't think a lot's changed. There's one tactical thing here. I don't think we need to spend any more time with experts. I only partner with experts. I'm only partnering with people who've done a lot of things in a positive way. It's just easier. My allegiance is to my investors. And so if you're a capital raiser over time, you have 2 critical partners. The operator partners, which I'm very close to. I'm on the GP side of the deal when I do their deals. I do due diligence with them. I work with them and help them with their marketing decks, communication decks. I educate investors on the deal. I go to the property, by the way, and make sure I really understand what the business plan's all about. And then after we get the investors in the deal, I stay with those investors for the life of the project. I'm the main point of contact. I'm giving the monthly or quarterly reports. I co-brand them. I'm there. I'm the first person they come to if there's a question, administrative issue. Hey, I didn't get my distribution, or hey, you know, I had an address change. Those are simple things. To hey, I saw the report. I had a question around this, right? So I am the operator. I am the part of the general partner team. I don't feel anything different than that. I just have one really, really specific role, though, at the end of the day, and that's bring very necessary capital to the operator, because it's a partnership. Without a good deal, a good market, a good team, I can't raise capital. Without capital, all that hard work is for none, right? So I really think about it as a team. I think I'm part of an integrated team. My partners are the operators. I get very close to the operators I work with. We do lots of deals together. I'm slow in moving to new niches. I'm slow to moving with new operators. I have my door open to almost all operators. I just tell them logically, you know, you may not be a good geographic fit. You may not be a good partner right now in your life and your cycle. I may need some more experience to be shown so we can get our investors on board. But and then my investors. My allegiance to my investors is huge. You know, I've developed working with an outside company now. I have a portal so investors can see all the deals they do with us. And so, I'm really focused on customer experience as much as getting money in the bank, because point 5 here on this list is really about retention. 85% of the people that provide capital through me into these operators are return investors and referrals. 85%. It's not like the last slide where everybody was new. Now it's much easier, but a bigger responsibility. And we're in the $75 million range now, and that's assets under management I feel responsible for. I've got that much money from my investors into these deals with these operators, and so I take it very seriously. But I do have fun, and I do make sure that I definitely have a good focus now on how to really retain those investors, and we'll talk about that in a second. But I really want to make sure that those investors are exposed to experts, and experts that you are now or will be, perhaps we'll be partnering together in the future. The second point, really, I could spend a lot of time. I can spend a lot of time on this, Dan, but this is something Joe taught me early on. He's obviously probably the king at this, and I think I do a pretty good job, but there's always things to improve on. But if you want to be in this business a long time, I did not go to this seminar, but this is the quote I had heard from a person that went to this seminar. This lady had raised billions of dollars. Obviously, you can get into billions when you're doing institutional money. I don't know if I'll get there someday, but if you're doing institutional money that are investing $5 million a pop, you can certainly get there. I'm primarily investing or raising capital from people who want to give me $50,000 to $100,000. That's pretty much my base. And one thing this lady said, she was actually at a seminar, and she was speaking at a capital raising seminar. And they asked her what her number one thing was about how she was able to raise so much capital. And she went out to the audience, and these are a bunch of people who are either raising capital or wanted to raise capital. And she asked this one question, what do you know about thought leadership? And maybe she said, in a room of 100 people, maybe a handful raised their hand. They didn't even know what thought leadership was. And I was like, wow. And I was introduced to this concept early on. And I do think it's the holy grail of capital raising. And why is that? Well, you can't just take your initial list of 150 investors or 100 investors or 50, whatever you think you have on your first deal, and expect those people to continue to invest with you, every one of those folks, and continue to do the same thing, because these are expensive investments, right? A lot of people need time to digest and reload. So you got to get new people through the door. And you're not going to cold call these people, because you need to qualify them. And there's a whole process around the cooling off periods. So there's a whole process. There's a whole idea around, how to touch people and how to do it in the right way. So what Joe got into my ear early on, and I didn't really understand the power of it until I've been doing it a long time. And he said, pick one thing. I don't care. You do a podcast. He was doing the podcast. So I didn't want to do a podcast. And he was doing one every day. I was like, wow, I'm not going to compete with that. So, but hey, it's still a strategy, and I think people can do it. A lot of people do it very well. But I said, I'll try my hand at blogging. And there's a lot of different strategies, and I'll talk about it in a second. But I just started blogging, and my goal was like every 2 weeks. And I thought that was I'm not sure if I could come up with that many ideas on what I was doing. But I started doing that, and 3 years later, I haven't stopped. I may have gone to monthly, once a month, and I would say that's probably not enough, but I do it when I can. I at least was doing it once a month, and maybe every 2 weeks. But I was blogging on something I was learning in the space. And I looked at my website the other day, and I had like 50 blogs. And about 3 months ago, I thought, with those blogs, I can probably write a book. And I'm on the West Coast right now doing speaking engagements with that book, and it's getting a lot of great feedback. And I was like, that's how my business has morphed. I just picked one thing, and I know on Bigger Pockets they track this. And the other day I looked at it, over 13,000 people had read my blogs, and I was like blown away by that, right? I was like, wow, here's me, have no really writing experience. I just was, speaking authentically through my experience. And there was enough people out there in that world that said, what you're providing is value to me at free of charge, right? I don't think about this as this is kind of an investment. And I was probably benefiting the most out of it because I was writing my thoughts down and it was kind of seeping in whatever I was thinking about. And I was just posting on Bigger Pockets, and I was also then putting it on my website. And lo and behold, now, for some people this could be more or less. I don't know. This is a big number, but every day someone comes to my website. Now, it could be 2 or 3 in one day. It could be 2 or 3 days I get one, but on average, one person a day now comes through the website, and invariably it's because they've read my blog somewhere, seems to be, or they read my book or whatever. I've got 2 out there now, these blogs, but they just come, and not all of them are investors, but a lot of them are curious and a lot of them are learning. But that's how I get my investors. It's like a funnel. I'm doing something, I'm providing some information to them. And this could be all sorts of things. You could do a podcast, you could do a blog, you could do a special report, you can do, obviously your newsletters are going to your folks. You can be interviewed on podcasts. I've got like 10 podcasts that I've been interviewed on, and they're on my website. And that's developing credibility, right? Over time, it's developing credibility. People are like, you're an expert in your field. Now, I've only been in this field 3 years, but I can tell you people think I'm an expert. I feel like I'm an expert because I've done a lot, but at the same time, it hasn't taken a long time to get here. I worked hard. I'm passionate about it. I love it. And that's super seriously the key. But, at the end of the day, you don't have to try all of these strategies, but there's a bunch of them. And, whatever you do, just do it consistently. That's what Joe always told me. Just do it consistently. And then once you get comfortable with that, maybe you layer on something else that you do. But whatever that is, you're giving. First of all, it feels really good. You're writing something down, or you're presenting something. You're providing an opportunity for somebody to learn. It feels good. You're giving. And then the second thing is it comes back to you. It comes back to you. And whether you're going to be $1 billion capital raiser or not, if you spend some time focusing on this, I got some things on my website you can look at around thought leadership. But that really is. You could spend a lot of time in this topic, and I think you will find that whatever you put into it, you're going to get out, multiple times, right? The third thing is play to your strengths. There was a guy, Tom Rath, that wrote a book called Strength Finders 2.0. And I learned this pretty early on that, you find out what works and you double down on it. And you find out what's not working, and maybe you stop going for a while or go less consistently. Now, I may offend some people, but I pretty much stopped going to my multifamily meetup group after about 6 months because I was driving a half hour. I was spending an hour and driving a half hour home, buying lunch there all the time. And I was thinking to myself, I'm meeting some people, but most of these people are service companies wanting to do business with me or active investors who really aren't looking for passive. And once in a while, I think after several months, I had maybe a handful of investors. Now, when you're first starting out, the shotgun approach, I definitely think you should do all of these things. But over time, I'm like, gosh, I was getting far more traction from Bigger Pockets, writing my blog and going into the forums. And I was getting a lot of traction with my wife's network. We decided to start hosting some little social events and things like that, just relaxed around potlucks and just relaxed and, sharing ideas. And those were the 2 things that went really well. What I was surprised about was a target-rich environment for me was, at the time I was working in high tech for a company called Dell Computer here in Austin, headquartered, 25,000 employees, making good salaries. And so I figured a lot of those people were accredited. I was a director over there, so I knew a lot of folks that should be accredited. But when I first when I first left Dell and got into this space, I think it's a very natural reaction for anybody to think, hey, Dave, this is quite new. Let's see how you do. I think mentally people say that. Let's see how you do in this a couple of years. And so that wasn't a very strong area. I got a few investors and some very important investors for me that are still my investors out of that. But not only till about 2 or 3 years later, when they saw Dave Thompson is still there and he's still doing things, and we still start seeing things from him. It looks like he's successful at this. Now that has become a strength area for me. And also now the multifamily media groups, I'm going back and now speaking. So those have become I'm speaking in Pasadena on July 3rd at a Phoebe group meetup. And it was an investor call just last week. And he said, hey, I actually run this group of like 75 people attend this thing. And we'd love to have you talk about either capital raising or what you do. And I'm like, that's efficient. That's an efficient use of my time. That's a strength. First of all, I love speaking. Number two, I just had a book that I just published called Riches and Niches about why I invest in these three areas. And he wants to talk about capital raising. Well, that's the other thing I love talking about. So great, just let's do it. And so that's where this thing's going to. I'm playing to my strengths, and now those strengths change over time. Those strengths change over time. So now, like I said, multifamily media groups who I wasn't really getting a lot out of, I now can give back to them in a much bigger way now, 2 or 3 years later with all these experiences. And you can be there too sooner than you think. And now, I feel like I'm giving in a bigger way, 75 people versus a one-on-one conversation. That's powerful use of my time. And I want to do a lot more of that. And, that's where I was talking to Joe just last week. I said, Joe, I think he did an East Coast swing, and we were talking about that. And I said, how did that go? He said, it was great. I was in Google last week. I was up in San Jose. I gave a couple talks, and it's not only the big groups. I had some of my two top investors that both work for Google, and we had dinner. I took them out to dinner, really nice, near Stanford campus. We had their husbands. And the next 2 days later, a lady calls me and says, hey, I want to show you around the Google campus. So we met her and her husband for lunch on the Google campus. I got a picture. I'm at Google headquarters, right? Mountain View. I'm like, this is awesome. This is something that wouldn't have been on my first deal, but this person has done like 8 or 10 deals with me. I'm a trusted advisor, business partner with her now, and she views that, and I do too. And so that's a valuable use of my time, because I want to continue to cultivate that relationship. And then obviously over time, she will probably refer me to some of her other folks at Google, which is a really target-rich environment. So play to your strengths. When you start out in this business, just find out what's working for you. And like Michael Jordan, I think I'm going to date myself a little bit, but you could be, I don't know, it could be Kobe for some of you. It could be some of the newer players, Durant. But what I'm saying is, if you look at those folks, they find out what they're really good at, and they spend a lot of time in the gym getting better at it, right? They don't try, they try to shore up some of the weaknesses, that's fine, but they don't spend all of their time on that, because they know if they're a great scorer, they got to keep practicing scoring. That's what they do. And so, like you, shotgun it first, but find out what your natural strengths are. Go read, that book I was talking, Tom Rath's book on Strength Finders 2.0. And it's a totally different philosophy than when we're growing up. Okay. I know when I was growing up, it was like, if you have some weaknesses, work on them. The strengths are natural. Don't need to work on them. It's the opposite, in my opinion. Flip it. Whatever you're, double down, triple down on the things you're strong at, and that'll really benefit you. And just make sure the weaknesses aren't too glaring, or have someone else do them. Find a partner who's really good at that. Stay away from it. So that's what I would do. The other thing is raise 25% more than you need. It's a very tactical thing. That changes for me over time. It's probably less than that for me now. It's probably 10%. If you're just starting out, it might be 50%. And that's really kind of a frustrating thing to think about. Oh, Dave, you told me, target was 500,000. Now you're telling me to raise $1 million or 750,000. Like, you'll thank me, because, in your first deal, a lot of people don't know you, and they get a little bit of stage fright, and they may just back away. And you don't want to say, I got 500,000 soft committed, and then it comes down to you only have 300,000. You can't get the deal done. So that's a very important tactical thing. All capital raisers, I mentor a team of folks, and I always tell them, get back up. Get back up, first of all, for you, and then we may need it for the team. So, raise 25% more you need is probably a decent yardstick. Life happens to people too. Don't think it's always you or the deal. It's just like life happens. I find this out. It's like, of every 10 or 20 people, something happens, right? Hey, my job was fine last month, and now it's not sure what's going on. A lot of just reorganization in my group. I want to stay tight with my cash. Or, hey, I was expecting that property to be sold, and you know what? We couldn't get the buyer to come to terms, so we're not sure that's going to happen. Or this is my favorite one. Right before they already soft committed, it's like, I have my money in an IRA. I have to go set up a self-directed IRA account, move the money And that's just that's a 2-week process. It may not make our timeline. So a lot of self-directed IRAs are fine, but sometimes you got to understand those cycle times. And so the last thing is, and this is what's happening in my business now. I don't think it was big early on. I think I should have focused more early on this, because the thought leadership strategy, you tend to spend a lot of time there, which you should. And for a capital raiser, you're always looking for the next new investor. And that can get to a point where you get lopsided. And I think that's happened. My business has been doing great, but I think it could do better. And this is kind of funny. So I advertised that I was going to be on the West Coast in my newsletter. Now, my distribution, I'm pretty transparent, right? I want people to learn. So let's say my distribution list is 1,100 people, right? Now, not all those people have done a deal. Maybe 400 or 50, maybe I've done a deal, at least one. Most of them have done a lot more, but at least one deal. I have my newsletter once a month. You could do different cycles, but at least once a month. I would say maybe you could, at least once a month. And so, but if there's something going on, like this meetup, this seminar, I sent to my distribution list of this, MFIN's coming up. But I sent this thing on the West Coast. I just started doing this because this is a family business trip. I did a Denver, San Jose, LA now, and I'm going to San Diego, and then I'm coming home. It's like 3 weeks on the road. It's a long time for me. But I'm able to do my business. Capital raising can happen. I'm doing 3 deals at one time while I'm doing this trip. Some days it's a little bit hectic, but the business goes on. Operators get deals. They never have a set schedule when those happen. So we just support that. But I love this. I put this advertisement out to my distribution list. I was going to be in San Jose, and I have investors from like Houston and Austin. Hey, when are you coming to our town to talk? And I was really jazzed about that. I was like, that's what I need to be doing. I need to be focusing on those 400 investors and the other folks that haven't done a deal. I need to be focused on them. And, what do I do to retain their business? It's not something that I had this kind of attitude, and I needed to change it, I felt. The attitude was, hey, the deals I'm getting into are doing well. And we've been fortunate. We're in an up cycle, but the operators I'm dealing with and the markets that we have and the modeling exercise we've done to be conservative deals, we're meeting or exceeding expectations, kind of across the board. So we're kind of getting spoiled a little bit. It's easy to focus on thought leadership, new people, keep growing that number, get 2,000 people in my network, 3,000 people. But there's a company in Austin that I know because they also provide capital to one of the operators I work with, and they're very big. I think they're $1 billion company. And I know them because I'm in Austin, and I've talked to them before, and they're very, very nice people and very hardworking people. But what I found out is they only have 300 investors. That's it. I got more than them. But I'm like, I'm not $1 billion company. And I started talking to them more, and they said, Dave, we actually spend a lot more time with the investors that we have, because if we spend a lot of time with the investors that we have and we really appreciate them, and we take them to, maybe our top 25 investors, we invite them to the Formula One race, we get a tent. And I'm like, man, you're not going to do that in your first deal, but as this business continues, my whole philosophy and focus is changing. And the referrals, they're just, come in even stronger because they are so excited about you paying attention to them beyond just them giving you money and you getting results. They want to feel like they're your partner. And I always tell them they're my partner, but I really wasn't giving them the focuser on that from an appreciation standpoint. And it's a little investment. Whatever I need to do from a financial would be small compared to what I get out of these opportunities. So, as a maturing 3-year into my 4th year capital raiser, which, I can't see myself stopping. I love it. I love what I'm doing. And that's probably the most important thing. But, I really want people to know that over time, instead of your first deal, you're focusing on just getting capital in the door, to look where my business is now. Now I'm focused on more efficient ways to reach more people through speaking or through books or through other things that can get my message out there deeper. And I want to care more about the 300 and 400 people that have done my deal. or our deal, our partners' deals, and really make sure that I'm communicating well with them. My communications are good. My customer experience touch points are good throughout the life cycle of the investment. But more importantly, what am I doing to continue to inform them, not just through my newsletter, but through, hey, why don't we do a wine and cheese a couple times a year in Austin, a couple times a year in Austin, Houston, and Dallas. This is where a lot of my investors are. Or San Jose, believe it or not, is like outside of Texas is my biggest market for my investors, and in California in general. So, I need to be spending more time out here, and I'm getting a really good reception. But it's all focused more on really retention now, and really leveraging that. So, Dan, I think I'll stop here. I want to make sure there's some time for questions.
Yeah, so let's go ahead and open it up now. And if you have some questions for David, please feel free to add them into the Q&A box so we can make sure that we get those. I know one of the questions on here earlier on was about your books. So what's the name of your books, and how can they get access to them?
On my website, I have one book, because this is a capital raising topic. And it was my first book I wrote right after my first capital raise. And it was called How I Raised $1 Million in 2 weeks. And it actually was 10 tips, Dan. I'm glad you brought that up. It's on my website at thompsoninvesting.com. You can download it for free. It's still on there. It's under press, I think, in my tab. The other one is Riches and Niches. And that's the latest one. I actually have that in a book form. Again, you can download that for free, and that's the one I'm speaking on right now. It just talks about my interest in apartments and self-storage mobile home communities. It has some really interesting charts in there, and I don't know if is my slide still up?
It is.
Because there are some charts in here you're welcome to borrow, because this is this is not proprietary. This is from Freddie Mac, and I like to. This is kind of going off a second, but I like to talk to investors about risk, even if they never ask me, because I think that's important. And this is such a powerful slide. It's like 1 out of 200 apartments in 2009, less than 0.5% were delinquent paying the mortgage, like 1 out of 200. And I tell people, hey, that's good markets and bad markets. That's good operators and bad markets. Think about if we were dealing with good operators, which we are, and we're only dealing in some of the strongest markets and submarkets. It's probably nil, the chance of you not getting your money out of this deal. You know what I mean? Because that's how you would lose if we can't pay the mortgage, right? Look at single family homes. Everybody's doing them, buying whole, flipping houses. That's kind of risky, 4 or 5%. Anyway, these are the kind of slides. I put a couple of slides in here. These are slides I like to put. This is part of my deck I'm sharing right now on my West Coast trip. A couple of these slides I just threw in here. That's powerful. Everybody's in the stock market, 401k, that kind of stuff, and IRAs, and look at that. And look at this. This is my favorite one. Look at that. This is if you sold the apartment. Dan, you and I wouldn't sell the apartment in the downturn, right? We may pay out 2%, but we're not going to sell. We're going to stop renovating to conserve our cash. If we didn't do that, we're not even going to have a loss. But look at the S&P 500 down 22%. So I like to have these kind of slides. You're welcome to borrow them. This is another one. Look at that. 5 compelling trends that favor apartment investing. If you're a new capital raiser, if you assemble why I like apartments, top 5 reasons, tax efficiency, cash flow, and you pop in a couple of these slides, you're welcome to borrow. Even before you show me your deck or deal, if you showed me that, I'm like, you got me halfway there. I'm ready to. I want to just show me a good deal, show me a good market, good deal, and a good team, and I'm ready to soft commit. If I have capital, if I'm qualified. There you go.
Great. That's awesome. And one of the other thing along the same lines of the books, there's another question here about what are 2 good books that you have read that have helped you grow your real estate business or changed your mindset?
Wow, that's a good one. I mean, this is kind of a cliche, but I know my first one was like the cash flow quadrant with Robert Kiyosaki, because that really helped me. And that was a long time ago, right? To really grow. Other books, I really feel that the most important thing is from a real estate perspective, there's been some other good ones that I've read. Who's the guy out in Boston? Lindahl. He's got a couple really good books about emerging markets, and about focusing on apartments. Dave Lindahl, I really liked his style. It's maybe it's not super technical, but it was really good. It was a good understanding of kind of looking for gentrifying markets and things like that. Yeah.
So the next question here is from Alicia. She says, I've been told for the first deal, you should look at family and friends. What's your thoughts if they invested but are not accredited investors?
If they've invested but they're not accredited, well, you have to have a non-accredited deal, right? A deal that would take non-accredited investors, and I would certainly favor family and friends getting in there. I don't really have a problem with that. I mean, if you think about it, talking to people logically, usually the people that you know in your first deal are going to be family and friends. I think they should just know. I think you should just do some preparation with them. I would never just show my family and friends a deal, right? So things that we talked about, why don't you paragraph with your investors if you're talking to them, or, why do you like investing? Why do you like investing in apartments? And have some kind of dialogue about that first. And then maybe the next time you get to them, if hey, this sounds interesting, I've got something I'm working on. Because the last thing you want to do on your first deal is, if these people are accredited and you know them, they have a relationship with you, that's great. But, just to show them a deal, I think it's too fast. It's too fast. They need to know why you're in this space, why you like it, and then the deal. I have no problem with family and friends. I mean, there's definitely more of an obligation to do it right. Right. Yeah.
The next question here is, do you see yourself transitioning into deal sponsorship, or are you taking equity positions in deals you have capital raised?
Both. I've already done that, and I still do that. Here might be a reason. Well, the easiest thing for me to do is just work with an experienced operator as part of I have to be legally part of their GP team, doing a variety of roles, really get integrated with them so I understand what they're doing, their criteria, go to the property, all that kind of stuff. So yeah, I'm raising capital for operators, but I'm a partner with them. I just have a specific role, an investor liaison role, that I stay with that investor the life of that deal. So I've done about 22 of those, 23 of those. I've sponsored about 3 deals. And why would I do that? There's a couple reasons real quick. One, I have an operator I work with, their minimum's like $250,000. They're very good, like a 53% IRR over the last 10 years on 17 exits. Fantastic. I want my investors exposed to them, but my average investors, I don't have many investors that invest at $250,000. So I then form a sponsorship. I create my own PPM. I have a group that does my back office, and then I sponsor. I fund into their deals, and they don't allow me to be part of their GP, and that's fine too. I said, well, you got a high minimum. I then turn around and offer it for $50,000 to my investors. So that's where a sponsor can add value. I can get you access to really super operators, and then turn around and create an experience for you that's more in your wheelhouse, right? So that's one reason I would do it. Yeah, I mean, it's not. I do get some. I have fees involved with that, and I can create even a better profit stream for me personally. All the deals I'm in, I have an equity position in. So all 26 deals, I do invest in the deals, and I have an equity position in. And that's another thing we didn't touch on. But if you can invest in your own deals, you're going to be asked that question, and you should. I don't think you have to bet the ranch. I tell investors all the time, I put some money in the deals, but I'm a financial planner mentality. I'm not going to put all my money in one deal. It's crazy, right? And you shouldn't either.
Oh yeah. So the next question here is about the slides. How can somebody get a copy of the slides for the PowerPoint?
I guess I just sent it to you, Dan. I mean, that's fine, or whoever organizes the event. Yeah.
And I'll post it in the forum. So just look for it in the forum next to the recording.
Yeah. I mean, these aren't elaborate slides, but I wanted to make sure we just kind of got touching on the basic stuff. And I know everybody, these are all recorded, right, too, so they can listen again and again if they want to.
That's correct. And let's see here. Are you looking to be on more podcasts? And I guess if so, how does somebody get a hold of you to invite you onto their podcast?
Oh, yeah. So it's David at thompsoninvesting.com. I think this information is going to be on the slide. There's my email. Okay. I love doing podcasts. I've done a lot of them, and it's good thought leadership for me. It's good to get out there. I'd love doing podcasts. So yeah, no problem at all. I don't care if you're new. I think, I just message out. So yeah, love to do them.
And then Jeff has a question here about what are you doing to stay SEC compliant, and how is your compensation structure set up with the sponsor?
That's a really good question. And it is a great subject. And I do get legal advice on how to do that properly. I think as a capital raiser, one of the most important thing is you have to be part of the general partnership team. Number two, you need to be doing a variety of roles. You can't just be capital raising. And when your compensation should be tied as a holistic compensation program, right? So you shouldn't get paid. You can't get paid like we would call we're trying to stay away from this broker dealer kind of concept, right? Because you really going down there is probably like setting up a business and going through root canal every day. I've been told. So, so we're basically part of we're just part of the general partnership. We're the sponsor. I'm part of the sponsorship team. But I do a wide variety of roles, and it's integrated into my agreement with the operator. It's an investor liaison role that entails doing due diligence. I go to the site. We help in creating the marketing materials. We educate investors. We stay with the investor the whole way. We are communicating investors through reporting, and we're answering questions. And we're just a part of the team. That's what you got to do. You can't just go in and raise capital. Hey, Dan, if you had a project, I raised capital, I'm out. Dan, you communicate with all the investors I have. First of all, I don't want to do that anyway. Those are my investors I bring into your deal. So the investors I bring in with this operator, those are my investors. They're the operator's investors too. I mean, the operator typically is going to send the distribution to them, K1 reports and everything. So we are together as one team. But I have the responsibility as Thompson Investing to maintain a relationship with my investors and to ensure that they understand the investment they're in and take care of that. So it's a holistic end-to-end role concept. Compensation is across the board. It has to be elongated. Oftentimes we're part of the asset management fee. We're getting part of the equity. There's part of a consulting fee up front, but it all has to be spread out over the 3 to 5 year hold. And that's how you stay more compliant, right? Makes sense?
Mm-hmm. And kind of on dovetailing that question is, do you need a securities license when you raise money for other people's deals, or how does that work?
Nope, I don't. No, I'm part of the team. I'm part of the general partnership team. Yep. So if I'm working with you, Dan, if you and I are working together, let's say we've chosen each other as partners, we're working together, we're talking about your deal. I'm going to be coming to your site. We're talking about the business plan. We're doing all the things I just mentioned. I'm just part of the team working with you. I have to be part of the general partnership, right? And then when I sponsor deals, I'm actually creating all the PPM stuff. So that's not even a question. But I'm not part of a lot of deals. I'm just part of the PPM. They actually mentioned my company name in the PPM. It's part of the team. I'm in the marketing deck. It just look and feel, But it just allows me to work with a couple different operators, so my investors can get some broader exposure. Yeah.
Yeah. Last question here is coming from Carolyn, and she's asking, what's the minimum that you would recommend investing with your own funds? Like, is it a certain percentage of the total raise?
Not a percentage of the raise. Most of the investment deals that we see, across niches with several operators is typically like a $50,000 minimum. We have discretion to go down to $25,000. It's about typically what I see. And so we don't really go less than $25,000. There are deals that I've invested, quite a bit, but for me personally, I do so many deals that I can't be putting in lots and lots of money per deal. So I want to make sure I'm putting in. The most important thing for me and my investors is I'm investing in the deal. They typically never ask how much I'm investing. And if I got that question, here's how I do it. I said the general partnership team is investing in the range of $200,000 to $300,000. I may say that, right? Because I know that I've already talked to them. I'm part of that $200,000, $300,000, but I don't really. Very few people buttonhole me and say, how much are you putting in? And I'm like, well, and that can change too, because I'm in deals where I'm the last person that if an investor drops at the last minute, I have to be ready to fill that gap if I don't have a backup investor. So I always kind of keep my powder dry to some extent. So I just tell them a range. It could be $25,000 up to $100,000 per deal, but it's going to be flexible, and it tends to be a little bit lighter because I always want to have that powder to go back more if I have to, or if I just feel like it's a good time for me, I got extra cash, I'll put more in.
Great. Well, Dave, I want to thank you so much for taking some time out of your early morning over on the West Coast, visiting some folks there in California. And
my pleasure, Dan. It was a lot of fun. Yeah, thanks so much for the time. I hope I shared some ideas that made sense. And anything I could do to support you and what you're doing and the folks on the call, just let me know how I can help.
Perfect. Sounds great. Thank you so much, Dave.
Thanks, Dan. Bye.